This is not financial advice, educational content only. Headlines keep circling the Fed's next rate decision. But the conversation one layer underneath, the one that actually shapes how long-duration assets price, how credit spreads behave, and where bank reserves end up, is about the balance sheet. Two tools: quantitative easing, where the Fed grows the balance sheet by buying assets, and quantitative tightening, where it shrinks it by letting them run off. The Fed has now run both programs at serious scale, and significant confusion persists about what they actually do mechanically. Today we're separating the mechanism from the mythology. Start with the mechanics, because the popular shorthand is almost always wrong. The Fed prints money is a phrase that turns up constantly in financial media. It's not accurate, and the inaccuracy matters for how you interpret what the balance sheet is doing. When the Fed does quantitative easing, it credits the reserve account of a primary dealer's bank and receives a Treasury security or agency mortgage-backed security in exchange. The Fed's balance sheet grows, but the asset side adds securities, and the liability side adds bank reserves. No currency is issued into circulation. The bank now holds a reserve balance at the Federal Reserve rather than the Treasury it just sold. Those reserves are not money in circulation in the standard sense. They sit on deposit at the Fed, earning the interest on reserve balances rate, IORB, which the Fed sets directly. Banks can lend those reserves to each other overnight in the Fed funds market, or they can hold them. Since 2008, a substantial portion has been held as excess reserves. QT is the mirror operation. The Fed stops reinvesting the proceeds when a security matures, passive runoff, and the balance sheet shrinks as those assets roll off. Reserves drain from the banking system. The question worth asking is, what does this actually do in markets when it happens at scale? The Fed's balance sheet before the 2008 financial crisis sat at roughly $900 billion, a size it had held growing modestly with the economy for decades. The crisis changed the operating model. 3 rounds of large-scale asset purchases followed. By early Fed's H4.1 statistical release, the balance sheet had grown to around $4.5 trillion. The Fed then held it roughly steady through reinvestment until late 2017, when QT1 began as a passive runoff. That program slowly brought the balance sheet down toward an estimated $3.7 trillion by mid-2019, but it didn't finish on its own terms. The September 2019 repo market disruption ended QT1 prematurely. On around September 16, overnight general collateral repo rates briefly spiked to roughly 10%, dramatic in a market that typically clears within a few basis points of the Fed funds rate. The proximate cause involved a confluence of corporate tax payment deadlines and Treasury settlement pressures, but the underlying issue was that reserves had dropped closer to a scarce level than the Fed anticipated. QT1 stopped and balance sheet growth resumed even before COVID arrived. COVID-era QE ran at a different scale and speed. The Fed added around $3 trillion in assets in the first half of 2020 alone. Sheet peaked near $8.9 trillion in mid-2022 per H.1 data. QT2 began in June 2022, initially at a cap of around $47.5 billion per month in combined runoff, stepping up over subsequent months. By early 2024, the FOMC began signaling it would slow the pace. The March 2024 meeting is when public discussion of tapering QT became explicit in the minutes. The mechanism that matters most for markets is what's called the portfolio balance channel. Here is how it works. When the Fed buys longer duration treasuries and agency MBS, it removes that duration from private markets. Investors who sold those securities, pension funds, insurance companies, foreign reserve managers, asset managers, now hold cash or reserves instead. To meet their return targets, they need to buy something else. That something else is typically higher risk assets investment, grade and high yield corporate bonds, equities, structured credit. This displacement pushes prices up and yields down across those asset classes. The measurable output is the term premium, the extra compensation investors demand for holding longer duration bonds rather than rolling over short-term bills. The ACM model, maintained by researchers at the New York Fed, is one standard framework for decomposing the 10-year yield into expected short rates and term premium. During peak Q periods, the 10-year term premium as estimated by that model went negative. Investors were accepting less yield for more duration risk than historical averages, which is the opposite of what a free market for that risk would typically produce. During QT, the dynamic runs in reverse, duration flows back into private markets, the term premium tends to rise, and the cushion supporting longer duration asset valuations compresses. Why does this matter for how you rate a macro situation? Because the 10-year Treasury yield is not just a reflection of expected Fed funds rates over the next decade. It equals expected rates plus term premium. The Fed directly controls one of those variables through policy rate decisions. The balance sheet is how it pushes on the other. That's my read. The September 2019 episode is the most instructive case study in what QT cannot do reliably. QT1 ended not because the Fed chose to stop, but because reserves drained faster than the system could absorb and short-term funding markets became disorderly. The Fed funds rate traded above the top of its target range, a technical failure, and repo rates spiked sharply. The core lesson: the Fed has limited visibility into exactly how many reserves the banking system needs to function smoothly at any given moment. Ample reserves is a policy framework, not a number that can be calculated precisely in advance. The threshold shifts with bank balance sheet behavior, regulatory requirements, and Treasury issuance patterns. More broadly, QE does not guarantee that banks lend. Excess reserves can sit at the Fed indefinitely, earning IORB without flowing into the real economy. The path from QE to real economic activity runs through asset prices and the cost of capital, the portfolio balance channel described above, not through direct credit creation. That distinction is what gets consistently lost when money printing is the frame, and the balance sheet cannot fully offset concentrated fiscal pressure. When Treasury is running large deficits and issuing substantial new longer-term debt, the net duration flowing into private markets can still rise even during an active Fed purchase program. What matters for market pricing is net supply to the private sector, Fed gross purchases minus new Treasury gross issuance in the relevant maturity bucket. That calculation is rarely front and center in coverage of either QE or QT. That's my read. What I watch in balance sheet data is not the headline size. 8 trillion, 7 trillion. Those numbers don't mean much by themselves without the pace of change and the friction showing up in funding markets. 3 signals worth tracking specifically. First, the weekly H.4.1 release from the Fed shows the balance sheet broken down by asset type and remaining maturity. Watch for deviations from the announced runoff caps. If the balance sheet isn't shrinking at the stated pace, the cause is usually in Treasury issuance maturity structure. If Treasury is issuing mostly short-term bills rather than coupons, less rolls off the Fed's portfolio naturally. That tells you something about how much net duration is actually getting returned to markets versus staying contained. Second, the reserve balance level, also in the H.4.1. During QT, watch the Fed funds rate and SUFR for signs they're trading persistently near the top of the target range rather than the middle. That is historically the early signal that reserves are getting lean relative to what the banking system needs. In 2019, the rate pressure in repo and Fed funds appeared days before the disruption became a public story. Third, the language in FOMC minutes specifically on the balance sheet. The minutes are meaningfully more granular than the post-meeting statement. When you start seeing phrases like appropriate level of reserves discussed with increasing frequency or references to adjusting the pace of runoff, the Fed is signaling that QT is approaching its natural floor. That's my read. The statement won't say it directly. The minutes usually will. The balance sheet is not a precision instrument. It works through portfolio displacement and expected path signaling, both with meaningful lags. For the next Fed cycle, one concrete thing to watch. When FOMC minutes discuss the composition of the balance sheet, specifically the split between T-bills and longer coupon securities. They're signaling how much duration the Fed intends to hold. A shift towards shorter duration holdings relieves duration pressure on markets even if headline size stays flat. That distinction won't be in the headlines. It will be in the minutes. This isn't advice, it's a way of looking. I'm Diane, back next briefing.